Welcome to Financial Revelations. I am David Safransky, and I have been gone for a couple of weeks. I haven't seen you guys in a couple of weeks. Actually, I don't see you guys. You see me. But it is good to be back. I also want to let you know that every Thursday, every single Thursday, I am on WCRF 103.3 from 8 a.m. to 9 a.m. It's 103.3. They have a bunch of repeater stations, but you could also get it on the Moody Radio app. And I've listened to the Moody Radio app several times. It's really good, super solid. If you have a phone, like iPhone or I don't know what other phones there are besides iPhones, but you don't need internet connection to use it. So it's really good. It's if you're looking on the Moody app, it's 103.3, the Brian and Janelle Morning Show. Every Thursday we do that. So I want you to listen in and support Moody Radio because over the years they have been super good to me. And it's how I met a lot of you guys. So that's really the first point of contact for a lot of us. Also, I changed the Twitter handle. It's at @SkiBucks and the number 1. And Josh is going to put that up here for you to see it. I want you to follow me on Twitter. Ask me some questions there. You could also send emails to Joshua at EPSF.com. Joshua at EPSF.com. That's also going to be up here for you to see. So if you have a question, you have a comment, if there's something that you'd like us to talk about, that's a great place to go to because Josh is going to tell me what you guys write, which he always does. And so we can talk about the things that are really important to you instead of just the things that are important to me. Now, today is an important day because it represents the biggest change in Fed policy in a long time. Now, the Fed had already raised rates one time coming into this Fed meeting. Today was the press conference, May 4th. May the 4th be with you. That's a shout out to Brian Dolan from WCRF. But they raised rates by 50 basis points today, a half a point, or for you, if you're going to a dinner party Friday night, always say 50 bips. They raised by 50 bips. That's how people in the business say it. All that really means is 0.5%. So the Fed came out today. They raised their Fed target rate. Now, mind you, mortgage rates are already north of 5%, about 5.2%. This is going to make mortgage rates probably go up to the 5.6%. And what they're going to do is by raising rates like this, you're going to see the available houses on the market. Just a month and a half ago, there was only 3 months of inventory on the market. So essentially that means in 3 months, if nothing else came on the market, all those houses would be sold within 3 months. Now there's about 6 months available inventory on the market. So what we're seeing is houses are sitting a little bit longer. Some of the high prices are starting to come down a little bit. You're starting to see, instead of price hikes, which you were seeing just 4 months ago, now you're seeing price cuts in real estate. And so I think the sweetest part of the real estate market is now behind us. The other thing that they're going to do is the Fed owns $9 trillion of government debt. Now, they own it in a variety of ways. They own T-bills, bonds, they own mortgage-backed securities, they own a lot of different government securities. It's not just the U.S. government is the issuer, but mortgage-backed securities are issued by the government, other types of bonds issued by the government. They're going to start rolling those off their balance sheet. Now, they're going to start low in June. They're going to give it a couple of months to let the market get accustomed to it. And then they're going to about $100 billion a month starting in starting in September. So what they've done today is they've given the markets, people like me, other people that trade in the market, big firms, other governments, they've kind of given the roadmap as to what they're going to do and how they're going to try and normalize rates. And one of the things I thought Chair Powell said that was interesting today, I also have another way I'm going to run this by you too. Chair Powell The only pirate charming. I don't know. I tested that one out. Uh, he was pretty clear that they don't really know what the effect of the balance sheet roll off is going to be. And so they're going to be very open to changes in that pace. So I think what you're going to see is the rate hikes they tighten everything up and interest rates go up because what they're doing is they're raising interest rates. So interest rates are going to go up automatically. But there's going to be a lot more competition for money. And when they're rolling off their balance sheet, what they do is they allow those bonds to come due. The federal government pays them back. That brings money out of the economy. That's going to tighten money supply. And it is possible that that is going to make interest rates in the broader market rise a lot faster than what the Fed would like. And so they may slow that down a bit. We're going to have to wait and see. But what I liked what he said, and what I was concerned that he would say, we're on a program and we're going to run this program. And the market was waiting for that sentence to come out. And I think the market would have been down 1,000 points as opposed to being up 1,000 points on the idea that, okay, we're going to do this. We don't really know what it's going to do because we've never done this before. And so we're going to be open to changes quickly. And so if they roll off the balance sheet and nothing really happens, then they probably will quicken the pace. I don't think that's going to happen. I think something is going to happen, and I think rates are going to rise a little bit faster than what they had anticipated, and so they're going to slow down the balance sheet roll-off. But that is the biggest impact to interest rates that they announced today, and it wasn't even about rising interest rates. So I'm of a firm belief that the Fed is a little bit behind the curve on inflation, because inflation's at 10%. So how could they not be behind the curve? But here's why they're behind the curve. One, we had a pandemic, and the government, the federal government, starting in 2020, is handing us money. They're giving us money. They're paying rent. The PPP loans were out. It would be counterproductive to raise rates into that because you're taking money away in one hand and you're giving it in the other. So it doesn't really make sense. When Joe Biden got elected, they immediately did a $1.9 trillion COVID response again. Probably it was one of the worst things that could have happened at the time because at that moment we were really coming out of the pandemic. People were starting to travel again. That really added to inflation. And so they're giving money again, raising the interest rates at that point. Again, you're just offsetting something. So it wasn't really going to have the impact that they wanted. And then Ukraine happened. Ukraine is a big wild card. We don't know what's going to happen here. And so they had to be a little bit gentle because it does have the possibility that this could affect our economy dramatically. So far, Russia has not shut off the gas pipeline to Germany, but we're coming into summer when there would have normally been a wheat crop coming out of Ukraine. Ukraine accounts for about 35% of the wheat production in the world. So that's not going to happen this year. So it is quite possible that we're going to see prices rise somewhat dramatically over the summer. And then there's a re-pandemic in China. Now, it's not really a pandemic in China. They're just, if one person in an apartment building has COVID, they lock down the whole apartment building. So right now, as we record, Shanghai and a lot of Beijing is locked down. And so the Fed was really kind of stuck in a holding pattern for a little while, but they're out of that now. In general, the pandemic is over here. Now, we may see numbers rising with COVID, but you're seeing hospitalizations fall off the charts because every iteration of COVID that comes out now seems to be a little bit weaker, far less virulent. It doesn't mean that some people aren't getting pretty sick, but by and large, nothing like what was happening in 2020. So I think that part is over. So the Fed is behind the curve. They have a little catch up to do. They're going to do 50 basis. They did 50 basis points today. They're going to do 50 basis points in June. They're going to do 50 basis points a meeting after that, most likely. And I think you're going to see interest rates dramatically higher by the end of the year. So what is next? Now that the Fed is in the game and they're in the game deep, I think what happens next is that I don't think you're going to see peak inflation, the high point of inflation, the high water mark. I don't think you see that till September, October. The good news about that is it's going to cause the Democrats to lose the House and the Senate, and that is almost sewn into the fabric of America right now. But the Republicans are pretty good at snatching defeat out of the jaws of victory, so we'll have to wait and see. But I do believe that they're going to lose the House by a very large margin. This could be contract for America type numbers when Newt Gingrich came into power. It could be 50 or 60 seats, and I think they're going to lose the Senate. Now, it's hard to lose the Senate by a lot just because of the way the math works out, and a third of the Senate is up for election every 2 years. It's never the whole Senate. There's more safe Democrat seats in this election cycle than there would be Republicans. So I think they're going to pick off a couple here and there, but they only need a couple votes. And I think what happens is, earnings have been pretty good. The economy in general is still pretty strong, even though we shrank in the first quarter. So you get one more quarter. If we shrink in the second quarter, we're in a recession. I don't think that's going to happen, but it's going to be close. But I do think that markets are going to rally into the end of the year, given that once the numbers start coming out politically, probably the end of August, beginning of September, the numbers politically are going to look really bad for the Democrats. And I think that the market's going to rally on that, because one thing that markets love is divided government, because not a lot happens. And I think essentially the Biden presidency will be dead at that point. And once that happens, that means no more judges that the Republicans don't like. The Green New Deal, dead on arrival. Build Back Better, dead on arrival. There's still a lot of control that they have over the oil fields. And remember, probably about 65% of this inflation has nothing to do with the pandemic. It has nothing to do with Ukraine or Vladimir Putin. It has to do with energy. And when the Biden administration came into power, when they got elected, they killed the Keystone Pipeline. They stopped oil and gas leases. They pulled all the permits for the liquefied natural gas ports that we would use to liquefy natural gas and send it to Europe. They allowed the Nord Stream 2 to go through. So they really immediately did things that were going to make energy prices rise, because they're all locked in on the new Green Deal, which is stupid. The new Green Deal is dumb, and it's gonna cost us our leverage around the world. One of the big advisors for the Biden administration is a professor named Paul Ehrlich. He's a professor at Stanford. He's been around since 1970s, and the thing he predicted that if we did not curtail our fossil fuel use, by the year 2000, England would be 12 feet underwater. Well, I read the Wall Street Journal this morning, and they didn't mention about England being 12 feet underwater. In fact, everything he's ever predicted has been wrong. And this is one time where you could actually prove the counterfactual, because we didn't do anything he said. We quadrupled our energy usage in fossil fuels, and the population of the planet doubled. And we're living longer. We have cleaner air, cleaner water. We're healthier. We have more food. We've never eaten better. Droughts don't affect crop production at all. It's really quite striking how wrong these people are on a consistent basis, yet the Biden administration still listens to them. So that'll all be gone to a large degree. They still control oil and gas leases, but that'll be gone in the next presidential election. So I do think that we're going to rally into the end of the year. I want to be equity driven. I'm still not a bond buyer in wholesale. There's just not enough money in it. There's just not enough return in a bond right now. And they're not safe, because as interest rates go up, bond values come down. So if you buy a 10-year bond right now, you're going to be holding it for 10 years. So be ready for that. Remember, you can contact us on Twitter. You can contact Josh via email. And we want to hear what you're thinking. We're going to be coming to you every week again now that my vacation cycle is over. I am David Safransky, and this is Financial Revelations. Thank you.